Hey, what's up everyone? This is Andrew here, and I'm going to go through the business breakdown of all the major business events that have recently transpired. So to start off with here, we have an announcement about a buyout. So Dunkin Brands is actually going to be purchased by another company. Now Dunkin Brands, they have, your Dunkin' Donuts restaurants and you get your coffee there and your donuts. They also have Baskin Robbins as their other major brand. Well, they just received a buyout offer from Billion Inspire Brands, and it's a 20% premium to what the stock was trading at. So the buyout actually came in at $106.50 a share for this Dunkin Brands company. And this is big because the last major big deal that was done in the restaurant industry was back in 2014, and that was when Burger King purchased Tim Hortons. Now you have this deal going through, which looks like it's going to be an $11.3 billion deal here. So that's pretty significant there. And with the 20% premium on the stock, it's good for Dunkin Brands. Next up, we have some news from electric vehicle company NIO, N-I-O. So now this company is primarily focused on the Chinese marketplace. It's a Chinese company. They're selling into the Chinese marketplace. And they also had some good numbers like a lot of these car companies that we are seeing. They actually delivered 5,055 vehicles in the quarter. This is important because it's actually double what they did from the previous year quarter at the same time. So 2,526 vehicles were done a year ago. The month's total deliveries consisted of 2,695 of the ES6 model, 1,477 of the ES8s, and 883 of the EC6s. So they don't have very inspiring names to these models of car here, but they're basically like mid-level sport utility vehicles that it's almost like a car, but it's going up into an SUV, and then the larger, more SUV style cars. That's what they're selling here. And year to date, as of the end of October, they've totaled 31,430 card sales or vehicle sales at this point in time. So that's pretty good here. You see that they're growing. You see the push in China, which I'm going to talk about later, to go more green technologies, and a big part of that is with the cars and the propulsion systems. But if you look at a competitor such as Tesla sold 50,000 vehicles in China alone. So Tesla is already beating them in their native market. But I guess the good thing for them is that they can just, now that the Tesla plant is actually in China, they have their factory there. They could always steal all that technology and all the business processes and the copyrights and everything and just put it in their own factory. So I guess that would be an advantage for them. But we'll have to see how that continues to grow over time. We have another buyout coming up next here. We have Stonepeak Infrastructure Partners buying Astound Broadband. And Astound Broadband is actually the 6th largest cable TV provider in the United States. And they're making this purchase for a $3.6 billion leveraged buyout. Big money flying around there as well. Next up, we have the company Google, which was recently in the news because they were, testifying before Congress. And if you want more information on that, I have it in the previous videos. But right now, we're going to talk about how the stock is actually doing. Regardless of the antitrust and the bad business practices that they're being investigated on, the actual stock hit an all-time high of $1,791.82. That's pretty incredible that even with that information going on that we discussed there, it's still hitting all-time highs. The actual business is doing well during the pandemic, just like a lot of these other technology companies. Next up, we have a bit of a strange partnership between Comcast and Walmart. So Walmart is actually going to start selling smart TVs. And the idea behind this is that those TVs are going to have Comcast new software on that for basically like Comcast trying to get into the streaming industry. Comcast is the one they're like the cable TV provider, and they provide internet to your house and stuff like that. Problem is, a lot of people are doing cord cutting and they're losing all these cable TV packages. I mean, after all, you don't need 180 channels that you might watch 5 of those channels. So everybody's cutting those costs. They're not paying hundreds of dollars a month anymore for their TV. And of course, that's hurting Comcast's main kind of like earnings streams. So by doing this, they have their new streaming service, Peacock, that they can also kind of embed in the software and everything. And it's going to give them a venue that's all over the country here, and they can just really sell these smart TVs and get a foothold in the streaming market. Next up, we have the Ant IPO. So I talked significantly about this last time, but now it just came out that potentially the world's largest IPO ever, $34 billion, is being held up now by some regulatory body in China. We don't really understand what's going on with it. I mean, they call up Jack Ma and they said, you got to get in here. We have to talk about this. And they said that it might not be in compliance with the listing rules now due to regulatory changes in financial technology. So I don't really know what changed in the past few weeks that made it all of a sudden, the government has to call you in and say we're putting this IPO on hold. But I mean, we don't know anything about this until we get some kind of news announcements from that area. Next up, we have Canada announcing an interesting new tax that they are trying to propose here. So they actually want to tax streaming services companies to put aside part of their revenue to fund domestic television and music production. So wait a second here. I don't know about you, but this doesn't sound like capitalism to me. They want to take the money from the new technologies of streaming services, that's Netflix and Amazon Prime and Walt Disney, Disney Plus and Spotify even, and they want them to pay for dying industries that their innovation is kind of replacing. That doesn't really sound much like how an economy should function there, right? So I thought that this was an interesting thing here. The actual industry in Canada is about 5 billion Canadian dollars at this time. And they want to take about $1 billion of that to kind of force those companies to reinvest into making and financing new television show, films, and music. I mean, this is almost like a cultural tax in that country there. So that's pretty crazy there. It's similar to what Europe is trying to do with their tax on digital goods, their digital tax. And I mean, now that I'm thinking about this is kind of like having phone companies pay a tax to support telegraph operators, because we need to keep those telegraph operators alive. So you might say, okay, but these new companies, they're not investing in Canada, so they need to do this tax to make them do that. Well, actually, Netflix already announced that they're spending 500 million Canadian dollars to produce original content in Canada. So you can see Netflix is already trying to do their own productions there. So why take the money from these areas that are using it effectively and put it into areas where the productivity or the efficiency is even less? I don't really understand that one. Next up, we have an announcement from the Federal Reserve. So the Federal Reserve came out once again and said that they're going to hold interest rates between 0 and 0.25%. So basically at 0. And they also said that economic activity has picked up here, but we're still not at pre-pandemic levels right now. So we're still struggling with the economy to come out of this pandemic. And now with the increases in coronavirus cases, it might not be that easy to do that. And if you look at some of the notes there, the Federal Reserve is still purchasing $120 billion per month of treasuries and mortgage-related debt. So this is their effort to kind of keep financial markets stable and support the economy. But this also keeps allowing everybody to keep borrowing, both the government and private individuals, at lower interest rates because everything is kind of based on that Fed funds rate. And if you look at what Jerome Powell actually said in his statement, he also said the U.S. government should pass their fourth stimulus package. They shouldn't be holding off until after the election, but that is the case now because it wasn't able to get passed before it. But if a stimulus bill is so great, do you really need 4 of them if one is supposed to get us back on track? And if the case is that we just keep doing this every so often, why not just have stimulus bills indefinitely, even in good times, to make things even better? I don't know. Next up, they said that they will not raise rates for 3 years. So that's pretty significant, and we're seeing this affect the mortgage market. So if you look at the average right now for a 30-year fixed rate mortgage, it's at 2.78%. That's pretty good mortgage right there. I mean, for less than 3%, inflation historically is like 2% or more a year. And you pay a little bit more than that for your mortgage? I mean, that's pretty amazing right there. That fell 3 basis points from the prior week. Now, if you look at this during the same time in 2019, mortgage rates were almost 1% more at 3.69%. So if you're going to buy a house, now's a great time. And if you had one of these mortgages from 2019 or earlier, it might make sense to refinance your mortgage here if you could get a 1 or 1.5% difference on your mortgage payment. Next up, we have the richest man in the world, Jeff Bezos, selling a lot of stock recently. So why is he doing that? We don't know, but we do see the results of what he was doing. He sold 1 million shares of Amazon stock. And that ends up being $3 billion that he profited from that. So now he has an additional $3 billion that he can go and spend on whatever he wants. Now, Amazon has, it's a couple $100 or $200 off of its all-time high. So it is trading at the high levels right now. But if you look at how much he cashed out total in the year of 2020, he cashed out about $10 billion worth of stock. Of course, that doesn't really affect him and his net worth. He still owns 53 million shares of Amazon stock. So that's about $170 billion it's worth right now. So he just has billions left and right that he has that he can spend on anything he wants. And if you look at his company like Blue Origin, he's funding that through his own sale of assets. So he can fund these other kind of initiatives or programs or businesses that he wants to do. But I just thought that was interesting that it's just such a large sale. And it was interesting he did it right on the end of the election rally. So businesses, they hate elections because it creates uncertainty. So usually once we have a president, which is still going on with all this counting, and then they finally decide. But at the end of that, you kind of have less uncertainty, and that helps businesses. And you can see him profiting from the election rally that we had in the past week. Next up, we have San Francisco trying to pass a new tax. So this tax is actually going to be called an Overpaid CEO Tax. So if you're a CEO and you're making too much money, which means you're making more than 100 times the average employee in your company, they're actually going to charge an additional tax, not on that individual, but on the company itself. So the company would have to pay an additional 0.1% of its annual business tax if they meet this criteria now. And this measure passed, with wide support in San Francisco. So you see, if the individual companies and shareholders are not taking action against CEO versus average employee pay, looks like city and state, maybe even federal, people are making their own laws now to do something about that.